Drill, baby, drill. So oil prices, WTI West Texas Intermediate to be exact, are now at 5-week lows. The WTI oil price has now given back all of its geopolitical added in there from the Iraq airstrike that President Trump did to the Iranian general. So one of the main reasons for this is as you can see there on your screen, is the record amount of U.S. crude oil production. Now, this is something that I've been talking about for months, over 6 months to be exact. The amount of increasing in oil production that the shale oil producers, in order to stave off or at least delay bankruptcy, because capital is not available to anywhere near the extent it was in the past, maybe if at all, to a lot of these shale oil producers. Now, the rig count, I don't have the full chart on there. I can't fit the whole thing. The rig count is down to 659. It got as high as over 1,100. So the rig count is down. However, the spacing in the wells is now tighter. The wells are closer together, so they're more efficient, so they can get more out of each well. And the efficiencies have increased over the years with shale oil drilling and the octopus pads. There's a bunch of articles about this on oilprice.com if you want to read more. I believe this is the most in U.S. history, 13 million barrels of oil per day. We are pushing. So this is the red line here, and unfortunately a lot of this oil production is not economic. It is not generating free cash flow. And this is why there was a scramble in the last week or two with all of that extra geopolitical risk priced into the oil market, where a lot of shale oil producers panicked and were hedging a lot of their oil production, records amount of it, like crazy. We're locking it in. So also, I'll read a couple more of these about the oil market with the refined product inventories. So the crude drop should be largely ignored, according to this analyst, Bloomberg Intelligence energy analyst Fernando Valle. Quote, the crude drop should be largely ignored considering the magnitude of the increase in refined product inventories. The nearly 15 million barrel increase across gasoline and diesel should be a major headwind for U.S. refining margins that are significantly above international markets. Exports were unusually weak and may ease some of the oversupply in the coming weeks, but the increase will likely lead to further refining run cuts. Gasoline looks particularly challenged at 5-year highs in days to cover. Also, oil prices extended losses in the last couple days, although they had a tiny little rally today, but the oil price chart does look like it's back-headed in a downtrend. Oil prices are extending losses after last night's surprise crude oil. This was from yesterday on Wednesday. Last night's surprise crude build reported by the API. It was not a massive crude oil inventory build. It was only, according to this other article from Zero Hedge on Tuesday, 1.1 million barrels. But analysts were expecting a draw in inventory. So remember what I said, if you're a short-term trader, these estimates for inventory builds or draws are often wrong, but in the short term they can move the price fairly with a lot of volatility, but long term it does not affect things as much. But these inventory numbers here in the US are mostly about short term. But 13 million barrels per day of, I would say, largely uneconomic oil production is mind-boggling. And that has to do with the debt. I've talked about this for over 6 months. These shale oil companies cannot stop drilling even if they're losing money, even if they're barely breaking even. And remember, in the last couple weeks, there was an anonymous survey submitted to the Dallas Federal Reserve that many of these companies, their break-even price, not free cash flow, not massive profits, their break-even price for oil was $50 a barrel for about 40% of the oil executives that submitted anonymously in the survey, and another 40-something% was over $55 per barrel. And here we are with WTI prices back below 60 at $58.63. So it's starting to get dicey, which is why so many oil companies, U.S. oil companies, hedged when the oil price got to the WTI oil price on the geopolitical news, with Soleimani in Iraq. Well, he is from Iran, but he was taken out in Iraq. And the geopolitical pricing of oil, the geopolitical risk started to get priced into the oil price, and we had a pretty sizable spike up to $63.27, I think was the most recent high on January 6th. And since then, it's gone steadily down. So it was smart at the time. It was probably smart for those shale oil producers to lock it in then. But that's going to keep a cap, at least in the short term, on the oil price, because you have so much more oil production, that I would argue is very uneconomic or barely breaking even still coming online. Excellent question. I just answered this. Why, Matuz Bach, why are they producing so much if it's so cheap? They're doing it because they have too much debt. They borrowed too much money to drill. They borrowed too much money to finish the wells, so they cannot cut production. So they have to. They need that revenue. They need to pay off the debt. So it's not that smart, but they're doing it to delay bankruptcy, and they're hoping that they can do this long enough that they can delay things out, not go bankrupt. So barely make interest payments on the debt, maybe roll over the debt, not restructure the debt, because normally that's in bankruptcy. Normally you refinance or you roll over the debt. And remember, the next 3 or 4 years, there's $100 billion of shale oil debt coming due. Absolutely massive. So in the next 3 to 4 years, either that $100 billion by the shale oil producers is going to have to be all paid off, or it's going to have to be rolled over, or more likely, I think a large chunk of it is going to have to be restructured in bankruptcy. They could sell some of their assets, but this is not exactly a buyer's market. Caribou Barbie. Oh, that's Sarah Palin. I've never heard that one before. That's actually really funny. So the shale oil companies, as I've been saying now for months, they're at the red line. They're pushing it. They have their foot on the gas pedal, and they are not even thinking about putting the brakes on. They are full pedal to the metal, full gas pedal, as much revenue as they can, even if the oil price goes lower, because clearly the oil price dropped, and not all these companies hedged back on January 6th or a couple days before that, when all the geopolitical risk caused a spike in the oil price. So back to some comments here from one of the Zero Hedge articles. The broader energy market is likely falling back into its familiar trading range, with WTI trading between only $52 and $63 a barrel, an analyst at Sevens Report Research wrote in their newsletter. So he thinks that oil will remain range-bound at those prices. Now on the high end of that range, some shale producers are going to make some money. They're going to be above break-even and maybe even free cash flow. But on the low end of that trading range, if he is right, there's also an interesting article on oilprice.com, why oil will stay above $50 a barrel, by my friend and former co-worker, also my mentor in the oil markets, Robert Rapier, who I've interviewed many times for this channel. Oil will stay above $50 per barrel. I'll read that in a little bit. So that would make sense. If oil goes to the bottom end of that trading range at $52 a barrel or lower, I mean, you're going to see there's going to be no capital available for a lot of these shale producers. There's very little, from what I hear, very little capital available for a lot of these shale producers now. There's there's not massive amounts of junk bonds left. There's not sucker pension funds. There's not sucker private equities, not except for loan shark prices. Maybe if they want to pay loan shark prices. Okay, so I'll read this Robert Rapier article, since I really respect Robert's work. He's so good. He's been doing this for 30 years now. He's been working in the oil and gas industry. His analysis is really good. We begin 2020 with the stock market again testing record highs. We just finished a year in which oil prices rose by more than 30%. However, natural gas prices closed the year nearly 40% lower, emphasizing the extent to which these two commodities have become unlinked. And that is because there is too much shale gas, and we don't have the storage facilities, we don't have the pipelines, we don't have all the LNG terminals set up yet. And unfortunately, these politicians are not investing in that infrastructure. So the governments are not going to do it, and because it's uneconomic to do so, the private sector is definitely not going to do it. The governments should be doing that maybe, but unfortunately, the governments prefer to squander money on a lot of other things, including bailouts and a bunch of other BS. Okay, back to the article. It's also an election year. Those tend to inject additional unpredictability into the markets as short-term decisions are often made to influence voters, e.g. releasing strategic oil from the Strategic Petroleum Reserve to drive gasoline prices lower. I believe Obama also did that too. So I think Trump and Obama both done that recently, and other past presidents, Republican and Democrat, have also done that. Against this backdrop, it's harder for me, as in Robert Rapier, to get a clear handle on the trends in the energy markets this year. Nevertheless, there are some disconnects in the market that I believe are likely to correct this year. I believe there are some high probability predictions we can make based on those disconnects. Below are my predictions for some of the significant energy trends I expect this year. As I usually point out, the discussion behind the predictions is more important than the predictions themselves. That's why I provide extensive background and reasoning behind the predictions. Again, this is why Robert is one of the best in the business, and why people pay at Investing Daily $400, $500 a year for his newsletters that I was working on in the past with him over there. Number one, for the first time since 2014, the closing price of West Texas Intermediate will not drop below $50 a barrel. And I think there's production cost reasons for this. Number one, if oil drops below $50 a barrel for very long, I think the shale companies are they're going pear-shaped. We're gonna keep this PG-13. We're not gonna go rated R and drop an F-bomb here, but you guys know what I mean. Oil is still the world's most important commodity, even though, everything's like anti-oil these days. So I always try to lead off with a prediction on the direction of oil prices. I generally make this prediction by looking at supply and demand trends as well as inventory levels. I also usually do a sanity check on my prediction by reviewing predictions from other analysts. Over the past few years, we started the year with an oil price that I felt was too low, so my prediction in recent years was for higher prices. This year, West Texas Intermediate, or WTI, opened at $61.17 per barrel and averaged $56.98 per barrel for the year. The year has only started above $60 a barrel one other time since the downturn of 2014-2015. In 2018, the year opened at $60.37 and it ran up to just over $75 a barrel before ending the year below $50 a barrel. The Energy Information Administration, or EIA, expects crude oil prices to be lower on average this year because of forecast rising global oil inventories in the first half of 2020. In contrast, JP Morgan is projecting an oil market deficit this year of 200,000 barrels per day. I've talked about the discrepancy myself, just to interrupt this article very briefly, and the major amounts of investments for years now, the most Capex by far in the oil industry, and the most oil production growth by far has all been in U.S. oil production and shale, and the U.S. economy has benefited heavily from cheaper oil prices. The U.S. GDP has benefited heavily from shale oil production, and jobs and the service sector jobs surrounding these oil areas in Texas, North Dakota, Oklahoma, Scoop and Stack, and some of these other places have benefited heavily. There's been a lot of jobs around those areas, and as Capex is cut, that will reverse, unfortunately. We've already seen some signs of it. It could get a lot worse. So back to the article, this year of 200,000 JP Morgan is projecting an oil market deficit this year of 200,000 barrels per day because of OPEC production cuts and demand growth in emerging markets. They expect oil demand, and also there's been a lack of Capex spending by national oil companies outside of the United States. So those are like Venezuela and other governments that own all their oil production, and they're not making Capex investments because so much of the government's budget is dependent on oil revenues that a lot of that oil revenue is used to fund the government and other social programs and other infrastructure, and it's not reinvested into the oil business. It's not used to upgrade their refineries. It's not used for exploration to go find more oil. It's not used to maintenance Capex. There's a lot of problems globally with the oil industries, especially from national oil companies. Venezuela is one of the worst examples, but there's a lot of others. Because of OPEC production cuts, demand growth in emerging markets, they expect oil demand to grow by 1 million barrels per day globally. So normally, according to the BP Statistical Reserve, oil demand growth globally has been fairly consistent. Now, OPEC's projections are saying that they expect weaker demand. So OPEC's latest forecast suggests weaker outlook for global oil markets this year, weaker demand. So OPEC is projecting weaker demand, but you have the BP Statistical Review, which tracks this thing extensively. Normally, industry-wide, Robert Rapier and others consider this the most accurate data set, that oil demand grows by 1 million barrels per day each year, and it's pretty consistent. So there's a 1 million barrels per day growth each year for many, many years. So the demand growth in oil has been very, very consistent for many years now. Consistent with most other forecasts. So you have discrepancy in different reports. So if you only look at one report, you may not understand the discrepancies. This is why experts like Robert Rapier are so good. They look at the different reports and they'll tell you and they'll highlight this. U.S. crude oil inventories are about average for this time of the year. Global inventories are slightly below the 5-year average. I believe there is a disconnect in the oil market between expectations and reality. There are lots of expectations that we are on the cusp of peak oil demand, but in reality, I think we're still several years away from that. Nevertheless, those expectations are creating headwinds for oil prices, but the only way the market also is the global economy is slowing down a lot. So he didn't talk about the global economies contracting, emerging markets, China, etc. But the only way the market corrects those expectations is for crude inventories to decline. Given the strong growth in U.S. shale oil in recent years, that just hasn't happened. Again, most of the oil production growth globally, a large chunk of it, I think it's over 70%, is from the U.S. That just happened. That's a lot of verbiage to set up the prediction, but there are a lot of moving parts here. Ultimately, I believe OPEC will continue to cut production in order to prop up oil prices. I think U.S. shale oil production growth is going to continue to slow. That's his next prediction, and that global oil demand will once again grow to a, there's a grammar error there, grow to a new record high. He said growth. I think the correct grammar is grow. But the oil markets look to be pretty balanced this year on average. That argues for modest oil price movements. In any case, crude inventories aren't high, and I believe OPEC will continue to cut production in order to prop up oil prices. So this is what OPEC can do. There's not a free market in oil. There's intervention and manipulation in the oil market by OPEC. They always try to move the price. Remember, they tried to bankrupt the shale oil companies 2013 and 14, and it backfired. So they lost a lot of market share to the shale oil companies, and they didn't bankrupt them. Now, we may see bankruptcies, a lot of bankruptcies in the shale companies, but here we are 7 years later, and many of those shale companies that OPEC wanted to go bankrupt in 2013 and 14 have not gone bankrupt. Some have called, not yet at least, some have called for oil prices to imminently collapse in the face of peak oil demand. I don't believe prices will go much lower than they are presently in 2020. In fact, for the first time since 2014, I don't believe they will drop below $50 a barrel. 2, here's his second prediction for 2020. U.S. oil production growth will fall below 1 million barrels per day. According to the Energy Information Administration, U.S. oil production closed 2019 at 12.9 million barrels per day. So we're already at 13 million barrels per day now, and we're not even at the end of January yet. For all of 2019, production averaged 12.2 million barrels per day. To put that in perspective, that's a high production rate for crude oil. That's a higher production rate for crude oil than any other country has ever had. Damn. Unfortunately for the U.S., it's not the margins and the low costs of Saudis. So, this is the highest amount of oil production in world history. It's an impressive amount of oil production. Unfortunately, it's not efficient, it's not economic, and it's not generating free cash flow. And I would argue it's been subsidized by the U.S. government and by dumb pension fund money, unfortunately. Sorry, pension fund investors who are listening to this, but a lot of your pension fund managers and your pension fund investment boards really suck, and you should sue the crap out of them because they're not doing their custodial duties. Class action lawsuits against the pension fund board and the pension fund manager. And there is a lot more pressure on oil companies to deliver Oops, I skipped a part. To put that in perspective, that's a higher production rate for crude oil than any other country has ever had. So the production rate now that the U.S. has is a higher production rate for crude oil than any other country has ever had. But production growth in 2019, which was 1.2 million barrels per day year over year, wow, was significantly less than 2018's record 1.6 million barrels per day gain. And there is a lot more pressure on oil companies to deliver cash flow to investors, let's say free cash flow, which means dividends, paying down debt, maybe buying back shares if you have free cash flow and you think your stock is cheap. That is going to, or starting a dividend or increasing a dividend, so there's different ways to return cash to investors. That is going to increase the incentive to focus on producing instead of drilling new wells. Thus, I think shale production growth will fall below 1 million barrels per day this year versus last year. There's also not investors throwing money at the sector who are willing to not take returns and basically subsidize the Capex to grow production. So he is saying that the growth rate of shale is not collapsing, but it is falling a lot. Will fall below 1 million barrels per day this year versus last year. That's also supportive of the previous prediction. He's saying the average natural gas price will be at the lowest level in more than 20 years. I'm not going to read that part. If you want to, I'll put the link, the article, oilprice.com article in the information and description section. On average, the U.S. will be a net exporter of crude oil. Prediction number 4. On average, the U.S. will be a net exporter of crude oil plus finished products for the first time. And his best stock pick, he says, and he's talked about this in other articles recently in the last month or two, he thinks ConocoPhillips is his best stock pick. Total return of 20%. If you want to read his argument for why he likes ConocoPhillips, it's outlined in the article. Again, it'll be in the information and description section. Okay, so let me take a look at listener questions and comments. Rob says 13 million barrels per day oil production is stunning. Yes, it is. It's impressive. Unfortunately, it's not efficient and it's not economic. And it's definitely not generating free cash flow. And according to the Robert Rapier article, no one has ever produced 13 million barrels per day. The Saudis produce a lot, but they do it, and the Russians do too, but they do it a lot more efficiently. They have lower costs and they're generating free cash flow. The shale producers don't have a choice. They're trying to either delay bankruptcy or prevent it entirely. I would most likely be in the delay bankruptcy camp. If they are lucky, they can delay bankruptcy long enough to hope that oil prices will rally and then they can refinance their bonds. Because I don't think they're going to be able to pay industry-wide $100 billion back in bonds. Rob asks, sounds like Jason, Rob says, not a question, sounds like Jason is saying shale is going to implode if there's a recession unless the Federal Reserve does an overt, not a covert. There's been rumors for a couple years now. There was a Zero Hedge article and there was a fight with the Dallas Federal Reserve between Zero Hedge and the Dallas Federal Reserve a couple years ago because Zero Hedge claimed to have sources inside the Dallas Federal Reserve that the Dallas Federal Reserve told local banks in Oklahoma and Texas to not call in loans when the shale companies were going bust in 2015 and 16. 2016, I think, was one of the record highs for bankruptcies for shale companies. So, unless the Federal Reserve does an overt bailout, so if there is a recession and oil prices do go lower, unless the Federal Reserve were to do an overt bailout, there is not capital available to help out or throw a life preserver to these shale companies. The amount of capital these shale companies have destroyed is Silicon Valley unicorn levels. Plus, the shale oil producers, in a lot of extent, have destroyed the infrastructure around the shale wells, the roads and the water. Frack water is not as clean as it should be. The roads are a mess. There's tons of video and articles about how the infrastructure around there is destroyed, and the oil companies did not invest any money into the upgrading or fixing the infrastructure. If you live in a shale oil area, I recommend investing in a very expensive water filter. That's not investment advice. That's health advice. Well, I can't give health advice either, so that's just my opinion. Okay, thank you, Tommy, for the super chat. B2 Gold, I have not looked at B2 Gold. Sorry, Tommy. This is an oil show. I will try to take a look at it maybe in the next couple days. I haven't looked at them in a while. I'm sorry. Kevin says, thank you for your videos. You're welcome, Kevin. Rob says 13 million barrels. Rob looked it up. Thank you, Rob. 13 million barrels per day. Oil production is 17% more than the Saudis' all-time high, which interestingly was November 2018 at 11.093 million barrels per day. The difference, Rob, is the Saudis are probably producing around $30, $35 a barrel, so they're generating immense free cash flow. The Saudi production costs are way lower. And yet you have people making enormous amounts of money for consulting gigs like Peter Ayhan and others telling people that shale oil is super economic at $35 a barrel. He's literally giving these presentations. I've seen them on the internet over the last 12 months. He has it in all of his slides, talking about how the U.S. is energy independent. The U.S. is producing shale oil at $35 a barrel, making profits, all this. I guess he makes 6 or 7 figures and doesn't know how to read financial statements. Rob, I think money markets are going into repo desperate for any type of interest income, for yield. This is an after effect. It's an effect of the central bank policy of financial repression, stealing interest income from people, for governments and large corporations. Why are you making fun of Robert Rapier's name, dude? He's a really good analyst. He's a friend and a former coworker. That's not really cool. You need a timeout. What is this like is this like junior high? Yeah, I've read Ron Paul's books, or at least a couple of them. GDC says Jeff Gundlach is predicting long interest rates rising that would really hurt shale companies. The long interest rates, the 30-year Treasury may temporarily rise, but the Fed has said a lot in the last 4 or 5 months that they will cap yields, which is Japanification. So I don't know the timing of when the Fed will start doing this, but they will do it eventually. RR says, and I agree with him, everything is surviving on low interest rates except for the people on Main Street because they fuck us over. Oh, the show's now PG-13 or above PG-13 because they screw people like us over with credit cards. So while the banks can borrow from the Fed very, very cheap, the people on Main Street don't get any benefits to that. Although maybe some people may be able to refinance on their mortgage at a lower interest rate. But now there's a lot of problems. There's a lot more paperwork. There's a lot more hoops to jump through. If you own a business now and you want to refinance your mortgage, the banks or whoever you're getting refinance from, if it's like an investment bank or something like that, one of the more slicker ones. They're going to want to know more about the cash flow and earnings of your business before they approve your mortgage refinancing and stuff like that. So even though there is lower interest rates available for mortgage refinancing, I believe there's a lot more hoops and a lot more paperwork and other ridiculous headaches to jump through. Yes, RR, this is what big governments do, though. This is financial repression. This is Japanification. Talk to the people who live in Japan and ask them if they've had deflation, like has been repeated ad nauseum for decades. So the mainstream financial media narrative is that Japan has had bad deflation for 20, 30 years. But if you speak to people who live in Japan, they tell you their taxes all their taxes. So there's new taxes layered on, and all the old taxes are increased, and their standard of living keeps declining unless they have like a good business or a good job where they're getting a raise, or they have a good business where their income is rising. So you have people screaming about deflation when in reality they just lie about the government economic data, so the CPI with the inflation rate. So they lie about that, and then they don't count increasing taxes as inflation. I count increasing taxes as part of inflation. Because inflation, to me, according to Ludwig von Mises of the Austrian School of Economics, is 100% government created. So therefore, we should add in taxes into inflation calculations. If you add inflation and taxes together, the picture is very, very different. But you're going to have all these talking heads and all these government economists and all these politicians and all these bureaucrats and technocrats screaming about deflation. There was a tiny drop in credit in 2008, about 6 months. Chris Martinson did an excellent chart on this. He showed this for years now. There's a tiny little blip in the drop in the amount of credit in 2008. And you had these Keynesians like Paul Krugman and so many others back then howling about the horrors of deflation. There was a tiny little drop. There was a drop in asset prices, obviously, but there was a tiny little drop in credit. And these Keynesians back then were screaming about deflation. Did your bills go down? Did the money supply didn't contract? The money supply was going like crazy prior to 2008. The bank reserve ratios were nuts. The amount of fractional reserve banking allowed by all banks back then was insane. The amount of money supply growth was nuts. The amount of credit issued was crazy until the small drop in 2008. And then the Fed had to step in with QE. Deflation is good for the regular person, but the governments and Keynesian economists hate it. Deflation is good. For the average regular person who's not up to his eyeballs in debt, saves money, wants more purchasing power from his savings, deflation is great. But deflation will not be allowed. Okay, got a couple more super chats. Thank you, Daniel. I appreciate it. Daniel says, thanks for the videos. You're welcome, Daniel. Tommy sent me another super chat, 10 euros. Tommy says, thanks for your research. You're welcome, Tommy. We're not voluntarily going back onto the gold standard. I don't think any government will voluntarily go back onto the gold standard. John, I did a show on that yesterday. Check the archives. What are my views on Trump's China deal and tariffs? Check the archives from the show yesterday. I'm very skeptical about really a lot of this stuff in phase 1 being completed. Another super chat from Lee. How do I feel about investing in uranium? Thank you for the super chat, Lee. So I think uranium has a lot of long-term potential. If you check the Cameco website that updates the new nuclear power plants, the uranium light pressurized water reactors that are being built, there's a lot of them being built in China. However, Japan is not restarting their reactors. Europe is still very skeptical about using more nuclear power. So I think, and especially if the global economy starts to contract, I think there could be more headwinds for uranium. Now, long term, I think this will get solved, but I'm not putting a lot of money into uranium right now. I think long term, a couple more years from now, maybe 3 years, 4 years, it's going to take a while. Uranium could do well. The problem is it's been in a bear market since Fukushima. So that's 2011. I was up fourfold on my Denison speculation. I bought shares of Denison. It was 2009, maybe. I bought shares of Denison for around $1 a share. That was the Lucas Lundin uranium play. And the stock had gone up to $4 per share, around $4 per share. Might have been over $4 per share in 2011. And then Fukushima happened. And within about a week, all my gains that I had on paper, because I hadn't sold, and I was expecting, this uranium bull market like Rick Roll and Marin Katusa and other people were saying to continue. But Fukushima happened, and within about a week, and I didn't see all the news out of Japan when it happened right away. I didn't find out, for hours until afterward, and by then the shares had already collapsed. So there's big risks with uranium. The risks are that a lot of these old nuclear power plants are not as safe as a lot of the regulators and politicians that built them have claimed. So there is a lot of risk with these old nuclear power plants. There was a lot of corners cut in a lot of them, unfortunately. So yes, there's a lot of potential for nuclear power. I would prefer liquid fluoride molten salt thorium reactor, but zero chance that will happen here in the United States. I publicly said that I like Chemico. But the Uranium Royalty Company, I looked at that for an hour or two in the last week, and that looks pretty interesting. There will be more analysis probably on the Uranium Royalty Company on a bonus podcast, audio podcast, or a written article for my Patreon account contributors. So Probe, if you want to know more about that, you can become a Patreon account contributor for $5 a month, and then you might get an update in there. I think Marin Katusa is a very smart guy. He's had some bad market calls. Geothermal, he lost people a lot of money. Him and Rick Rule did. Lost me a lot of money, too, on geothermal. And then also on uranium and some other junior miners. The link to my Patreon, let's see here. I don't have it up right now. I'll put it in the information and description section, and I'll also put it in the comment section after this video. So I think Marin Katusa is a smart guy, but he likes too many junior mining companies. I don't like juniors that much. West Virginia is offering Virginia to rejoin. Oh, God. Unfortunately, Virginia is two separate states in a lot of ways. I mean, officially it's not, but if you've lived in Northern Virginia and then you've visited Southern Virginia, like I went to college in Southern Virginia, it's basically two separate states. Northern Virginia is very hardcore Democrat now. It's changed a lot in the 20 years I've been here. It's gotten way worse. Rob says the Wall Street for Main Street YouTube channel needs to break 30,000 YouTube channel subscribers right away. Yes, I agree. It should have done it a long time ago. I think we're under 300 new subscribers needed to get to 30,000. Northern Virginia has less taxes than Washington, D.C., though. Rob, people are unsubscribed without even knowing. I get emails. Rob says, I don't know how people don't immediately subscribe to this channel, frankly. A lot of people who are longtime subscribers are unsubscribed. That's the truth. People have to check. I get emails a couple times per week from people who are longtime listeners who are unsubscribed without their permission by YouTube. And I hear other channels in other spaces like comic books and sports and some of the other channels, they're having similar problems. YouTube is a mess. Okay, well, so Lee, to answer your question, if you're patient, it could pay off in a couple years, but I'm not putting a lot of money in uranium. The sector probably needs to consolidate. There's a lot of risk. The risk is if there's another Fukushima and how long the oversupply that was of uranium, because Cameco was going on the open market and not mining, and it was more economic for Cameco to basically be a hedge fund and not mine uranium and to buy spot uranium on the open market that Japanese nuclear power plant companies were still flooding the market with, buying spot uranium on the open market that Japanese nuclear power plant companies were dumping on the market. They've been doing this for years since Fukushima. And then selling that, Cameco would buy that on the open market at spot prices and then go and sell that into their long-term contract price. So it was more economic for Cameco to be a uranium hedge fund, a uranium trader, than to actually mine uranium. So until that changes, I think Cameco will survive. I think there's a pretty high, in my opinion, there's a pretty high probability Cameco will survive. A couple years, maybe the stock more than doubles. We'll see. Maybe. If the bear market ever ends. On paper, the uranium royalty company idea is a very good idea. There's some problems with it. I will highlight those problems in the behind the paywall on the Patreon account. Because if I'm going to do analysis and talk about the risks, I should probably get a little bit of compensation for it. There's some interesting risks that were highlighted in the investor's presentation and some of the other things I was looking at. I don't praise... Keebler Orc says, I don't praise the liberals enough to stay on YouTube's good side. You're probably right, buddy. But last year I did add... my channel was going gangbusters. At one point I was adding 2,000 new subscribers per month, and then it just flat out stopped. It went to 0. So it was growing like crazy until about 4 or 5 months ago, and then it went to 0. And then I was lucky to add 100 new subscribers a month. All I can do is really just focus on the content. So videos like this, short videos, interviews, things like that. And the rest will take care of itself. I mean, as long as I'm making a living, making my content, I don't really care if my channel grows too much. If I'm making a decent living, that's priority number 1. And I'll worry about the other growth and stuff like that later. Okay, so I think I've been rambling on enough and checking listener questions and comments long enough. It's longer than I planned to do for this show. So there's the Robert Rapier article about his predictions for 2020. And I'll put that in the information and description section. And also the 2 articles about WTI giving back the gains after the Soleimani airstrike in Iraq. And that's on record, actually all-time oil production. So the U.S. now has higher levels of oil production than Russia has ever had and Saudi Arabia has ever had. However, it's not economic. It's very inefficient. It's not generating free cash flow. So this is a train wreck question of when and not if, I think. It's not looking good for a lot of these shale companies, but they're gonna... Did you ever see that movie Thelma and Louise? It kind of reminds me of Thelma and Louise. Because what did Thelma and Louise do? They punched it. They tried to jump with the Grand Canyon. They put the car pedal to the metal as fast as they could, and they went off the cliff. It's kind of like that, or like Wile E. Coyote. I feel like the shale oil companies are Wile E. Coyote. And at some point, they're going to look down and they're going to see, it's going to be like Wile E. Coyote holding up the sign saying like, please help, or oh crap, or end cartoon now. I think that's what the shale oil companies are going to do. Okay, bye everyone. Thanks for listening, and there will be a lot more great content coming.